good morning to you. Today is Wednesday, the 19th of August, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. This week, the theme is a practical way to use an advisory board, because advisory boards should not become another meeting where experienced people exchange opinions. It should improve how the company makes important decisions. And that starts before you think about the CV or the reputation or the experience of your next advisors. It starts way much earlier when you define your milestones, your goals, and then you look for the right profiles to advise on those specific business outcomes, right? So that is the theme of this week. So the advisory board is not a thing that you come as a result of an impulsive, put it that way, an impulsive say, we need an advisory board. It comes with a strategic plan before even considering who is the right candidate or the right profile to fill that seat. So yesterday we talked about scaling, the difference between scaling and growing. Today we move into the right-hand side of the advisory board operating system, which is the growth and capital, the predictability. So when you're looking for funding, what you're looking for. So we should look into this section on the right-hand side, partnerships, revenues, and asset, which is predictability. Milestone number 2, which is a growth and capital, right? So I have a mistake here in the graph, but don't worry about that. It's understandable what we're talking about. Now, this is where many conversations change. Why? Because growth is very exciting, as we mentioned yesterday, or scaling, but capitals tend to ask less exciting questions. And actually, we are going through a process of due diligence today. And at the end, after a week work, we have to reconvene all the parties again and say there is a disconnect in what we are doing, because one part of the team, of the group, were saying everything what they believed in words, letters, and the other part of the organization, the team, say we want to see numbers, right? So it was a complete disconnect in terms of conversation. The work was progressing, but both teams were starting to get irritated one to the other, because I already explained you what we do, how we do it, and the team were asking and say, I don't see that reflected in the balance sheet, the P&L, etc. So I decided to put both teams together in a 30-minute call, believe it or not, and they say, guys, we have letters and numbers. We have to bridge these. How these letters transfer into numbers and how these numbers understand the letters on the other side. And actually that started to clear the air, if you may, and people say, all right, now we understand what we're talking about. This is a translation exercise. It's not one team against the other team. So that's why capital tends to be less exciting, because it's all about numbers. It's quite binary. This is pluses and minuses, and that's it. So the question will come in the way that what do you need or when do you need the money? Why that amount? What will it fund exactly, right? So if you explain this in words, but you cannot translate it into numbers, it's a very hard conversation. So, for example, what happens if revenues arrive later? And I say, well, but look at the track record. But track record doesn't mean that actually is predictable the future of that collection. What happens if margins are lower? Other question would be, how much control are you prepared to give away, right? So what do you mean control giving away? And we're going to discuss this, the difference between debt and equity. And what happens if you need more capital 6 months later after the round? So these are not questions designed to kill ambition. These are questions designed to understand whether the ambition is financeable or not, right? Ambition is good, but at the end you need to show that you can deliver, and not only you can deliver, also you have a plan or a capacity to serve that debt or that commitment if you are going for equities. Now, let's take a look at three problems with this. Problem number one is a reactive funding. The company waits until it needs money, and the capital discussion becomes urgent. And when things are urgent, it feels like momentum, like, yeah, let's go, let's get the things happening, move the things, uh, imprint urgency. You've probably heard that before, particularly in sales teams. That's externally, but the externally, urgency can weaken your position, actually, particularly if you're looking for capital. You have fewer options, less time, less room to compare terms, right? Less ability to walk away. So the capital planning is stronger when it begins before the business is under pressure. So one of the functions, I have this advice many years ago. One of the, the most successful CEOs and CFOs are the people that actually have a design in terms of finances, and they build connections and new sources of capital, some of them years before they need the money, some of them years before they need the capital, right? Why? Their function is to have that stability, that way to have the options. We spoke about optionality and transferability last week, so you can watch those videos. But here is, in terms of capital, you want several options before even you need them. And you know what will happen is a boomerang effect, because you don't need it. Probably you've been offered more than actually if you really need it. Because when you are in an urgency position, the natural reaction is, I don't want to get involved here because this seems to be desperate, right? This is a sensation, desperation. Urgency is sometimes confused with desperation. So you have to be very careful. Problem number two is a finance without design. And this is something that pretty much you guessed at this point. So leaders talk about funding as if all money behaves the same way. Unfortunately, it does not. And here's the point. Debt has repayment pressure, right? So you have to commit to pay in certain ways and under certain terms and conditions. But equity, you say, oh, we give equity away. Well, equity changes ownership, convenience, and this affects the freedom. Investor rights affect future decisions. Different instruments solve different problems, right? So you have to be careful how you are positioning your capital raise, debt or equity, and different problems, different things to solve. You have to understand what the capital enables and what it constrains, because many people only focusing, oh, this will allow us to A, B, C, D, but under which conditions? Because a clause today that seems to be harmless, tomorrow can be the full change of ownership of control of the organization. So you have to be very careful what you're signing and on which terms and conditions. And problem number three is the optimistic timing, right? And here's I'm talking about the hype, if you may, or the pump of adrenaline when you're doing things, and then you face these walls of timing, urgency, optimism, design, and you say, why we have to do all this? Well, the optimistic timing is because management assumes the raise will happen by a certain month, date, or week. A lender will approve, an investor will commit, a large customer will sign a contract that will allow you to do all these things, and then one thing slips, and that happens to me many times. So the company discovers its plan relies on perfect timing. That is not predictability. So the calendar, the week, the day is not the predictability you're looking for. That is a dependency on the calendar behaving itself. So if you are pushing a calendar, yeah, it's true. You have to have a deadline, you have to have a time to do things. But believe me, it's better to take a bit longer to design the things and have options than actually push it for one lender, one investor, one shareholder raise, and then find out that actually because you were working on a calendar, you forgot to put all these other things together. Now, you can imagine this happening like this: a capital as oxygen, an oxygen tank, when you are scaling or you are climbing at high altitude. Yeah, you can have the right route, perfect. You have a strong team, perfect. You have trained for months, perfect. You have the weather forecast that is in your favor, absolutely fantastic. But if the tank is too small, arrives too late, or does not connect properly, the climb literally stops because you don't have the oxygen. So you can present, what I'm trying to illustrate with this is that you can present the perfect planning, the perfect timing, the perfect team, everything fits, everything is right. But if the capital doesn't arrive at the time that you need it, all that perfection might not work at all. So bear in mind that capital is pretty much on the predictability side. So you have to make sure that all what you plan or what you do also have a functionality of predictability, not only for yourself, mostly for the investor side, for the lender side, for the shareholder side. They want to see that predictability very, very clearly, not in letters and words. They want to see it in numbers and the evidence that those numbers are backed by solid contracts, pipelines, commitments, expansions, etc., etc. Right now, as a board advisor, what I would propose to consider is the following: how you manage all these things. Start with a capital map, and this is very, very easy to put together. Put every funding source on one page, and I like one pages because it actually force you to think and to cut all the fluff. Right, so put it in one page. What are the loans, the facilities, the equity, shareholder funding, any important refinancing dates that you have in mind or are your planned. Then put all the restrictions, the convenience, the covenants, any investor rights, any decisions that require consent. Do not make this a finance only document. Make it a board document, a document that your team can read and say, understand what is the A's and the B's here, right? This because some funding decisions change the control, as I mentioned, for example, equity, and some change timing or some change risk, which could be debt. The second step is connect the capital map to your revenue, right? What needs to happen commercially for the plan to work? And which revenues are assumed? How dependable are they? How quickly do they convert into cash? So your collection timing. So you have to be very tight on that one too. What happens if the largest opportunity moves by 90 days, right? So let's say that you have a big contract. We were talking, actually, we are talking with a company that the revenue doubled in 6 months. And the challenge is that the contract has 120 days payment terms. The in paper is a fantastic deal, right? Double the revenue in 6 months, and the contract is quite lengthy, it's like it's 3 years or so. But the payment term, 120 days, is a cash flow killer, right? So the company have to go externally now to do an invoice in finance to make sure that actually they have the cash flow to deliver, because in these 120 days they have to deliver, right? Now, what is the challenge here? If this payment, for whichever reason, delays beyond this 120 days, what will happen with that invoice financing that we committed to, or we were thinking about to commit to, right? So these are the things you have to think about before going into the institutions, investors, or the lenders. So that one scenario often tells you far more than another perfect forecast, because actually the forecast in paper and the spreadsheet looks amazing, but you have to put that prevention there. And it's very, very hard to go to a lender and have the question asked to you and you go blank, like I say, oh, we haven't considered that. That is pretty much a red flag for any lender, investor, or facilities that you can check, instrument that you can check with your bank. Now, the final step is the assets. What is the capital building? So when you get the investor, the lender, or the shareholders around, so what is exactly you need the money for? In that particular case, is cash flow to continue the operation, so operation expenses or operation capital. So another layer is another layer of headcount. There's technology, intellectual property, market access, production capacity, which is a case that I just mentioned, a stronger revenue engine, right? You should know which lasting asset the capital is expected to create. So otherwise, the business may raise money to fund more activity without becoming more valuable, right? So in this particular case, it's more valuable because I increase a lot of things, but at the same time, that you have certain risk there in terms of if the collection fails. This is also where the partnerships matters. So a funding partner is still a partner. A strategic investor may bring more than cash. And remember that a lender mostly brings conditions, right? So when you're going into debt, but an investor also might bring influence, connections, and networking. So also is something, the things that you have to balance out. What are you trading off in terms of where the capital is coming from? So you should have a full understanding of those exchanges. This is where an independent advisory board helps, because the CFO sees that model, the CEO sees the strategy, you as a founder might see the opportunity, and all get very exciting. But the person who has raised capital before, and negotiated debt, or lived through a failed funding round sees other patterns, and they ask other questions. What happens if the raise takes twice long, right? What happens if your valuation is lower than expected? That might happen too. What happens if the lender tightens the conditions? What decision rights are you quietly giving away? We mentioned that one. What happens if you have to do a next round? If you do this round, what will happen if you have to do another round, right? And you say, why we need to think about this now? Because all these things are layers of causes for future potential consequences. So you have to minimize negative consequences, and amplify positive consequences. So they can see the plan works, but mainly if timing goes perfectly or not, right? So this is kind of the advisor that you're looking for. So they say, can we see this? The plan really works, but if timing goes right or wrong, they might see the company has several funding choices, which is absolutely fantastic, but the trade-off had not been made clear enough. So they will slow you down, or they will pause on making a decision until they understand clearly what exactly is going on in terms of the funding choices. And also the planning raise, the raise while they're should be planning the capital structure, right? So instead of planning the raise, like a go to the market and find money, they say, what about planning the structure first, the capital stack, how it's going to play everything in that case, in this raise. So that what that means, that actually in the future you will have more chances or better choices or options than going for one race and burn all your capacity in one go. So that is the predictability challenge. Good capital planning does not remove uncertainty and risk. By the way, it makes uncertainty and risk easier to manage or to mitigate, right? So it shows that you're aware of things. It doesn't mean that you have to eradicate them. It's impossible. But if you understand what are the risk and you disclose them and say these are our measurements to manage them and mitigate them, I can assure you that raises a lot of good will on the other side, because they understand, or they can clearly see that you are aware of things and you're not hiding things or assuming things, which is worse. If the worst thing that can happen is that you believe, or you be perceived as somebody that is assuming that everything will be fine and you will manage when something happened. It might be the case, but if you are upfront, disclosing and showing mitigations and management and risk management, I can assure you that is a more solid plan. It's a better structure, a better design of the capital stack than going to and assume that everything will be fine. So, and so this is where you start to go from a reactive position to a proactive position. And that is very, very welcome when you talk to investors, lenders, and shareholders. So what do you gain working with me? Three things: business outcome, differentiators, and risk reductions. In terms of outcome, it's more a fundable growth plan. The capital requires what capital requirements are, revenue assumption, risks, and trade-offs become clearer, and then you can disclose them and put risk management mitigations in place. The differentiator is an international advisory board assembled around the growth and capital milestone. Finance, investor readiness, commercial and governance expertise arrived without expecting one permanent hire to cover everything. And the risk reduction is the reactive funding. Instead of being a reactive company that actually, oh, we need funding, we go to the market, to be a proactive company. You start to plan ahead, sometimes years ahead of the real needs. And that is a very, very good position to be, because you have options, the company is valuable, you can explain things, you have risk plans in place, etc., etc. So the advisory boards stress test the capital story before outside investors or lenders find the gaps. You don't want people to find the gap. It's not, nothing is written in stone, but at least when you start to show up that actually you understand and you're aware of certain risk and uncertainties, etc., etc., and you have mitigation plan, or at least you flag them, that is very, very welcome, as I mentioned. Now, let's wrap up today. One action plan that you can, or one action that you can take today, and it's 30 minutes or less, is not a big stress thing. Here's our visual aid as usual. And I share this in LinkedIn so you can screenshot or download it from LinkedIn. So take your current growth plan, right? And change only one assumption, the assumption that I mentioned earlier. Revenue arrives 90 days later than planned. And then ask what happened to your cash, your margins, your investing timing, and your need for capital. If the plan breaks immediately with this only one question, revenue arrives 90 days late, you have found one of your predictability issues, right? So let's leave it for today. We'll reconvene tomorrow again, because tomorrow we move into systems, the things that make things work. And the system is not IT only, software and hardware. It's about your workflows, your operational procedure, how you do things, your triages. Triages means who, if something goes wrong, who is going to be called at what time, why, and which is the next person in the line to operate that or to manage that risk. Because capital only stays useful when the company has controls and resilience strong enough to protect what the money is building, right? Now, if you're a founder, a chair, a C-suite, a CFO, CEO, that with more than 50 employees or more than 10 million revenue, and you want an international advisory board to stress test your growth and capital plan, let's have a chat. In 30 minutes, I can understand. I would love to understand where you're coming from, where you are today, where you would like to go, and then we can put the milestone of predictability and how to put it together with an international advisory board for your company, and how that can produce the results that you're looking for. So have a great day, and we'll talk tomorrow. Thank you, and bye-bye.